Why is Fitch, I mean, those are very strong words from Fitch, because I remember that the central bank governor has at several times said that the Nigerian banking sector is strong at the moment and will receive sovereign support. So why does Fitch insist that this may not be the case?
Right. Hi. Well, we have to remember that Fitch's criteria, the way Fitch analyzes banks is we look at a two-path approach. One is a bank on a standalone financial strength, which we call a viability rating, and the other one is support-driven. So you're quite right. Unusually for a country, in Nigeria, we say that we cannot rely on any sovereign support for the banking sector. And the reason for that really is a combination of things. The first is that we've never received sufficiently firm messages of support from the authorities. And the second most important consideration is that Nigeria, let's face it, Nigeria's sovereign rating at B+ is relatively weak, and its foreign currency reserves are quite volatile. So they have been increasing lately, but would that be necessarily sufficient to provide support to the entire banking sector in foreign currency? And indeed, would they prioritize banks if they needed to over other essential sectors of the economy? So we took the decision about 2 years ago that support would be taken out of Nigerian bank ratings, and all the banks in Nigeria covered by Fitch are rated on a standalone or viability rating.
But do you see threats in the system right now that could take us down that path? We're coming out of recession, and when it comes to a bank's profitability and earnings, that has been a bit slow, but we've seen some improvement. But the overall economic environment and operating environment hasn't been too supportive of these banks. I mean, just taking a look at some of the loan book of some of these banks, the asset quality and the NPLs of some of them, one can just get a clear picture of just how unsupportive the economy has been. But is this a real threat going forward?
No, not really. If we look at, starting again with the sovereign, Fitch took rating action on the sovereign on the 2nd of November, so the outlook for that B+ sovereign rating was revised from negative to stable. So that would imply that things are getting better. And also the rating action that we took on five of Nigeria's largest banks that we took on Tuesday exactly, we have one upgrade, which was UBA. We have two outlook revisions from negative to stable on GTB Zenith and also on FBN, and Access's rating was affirmed. So there hasn't been any negative action, and in fact, out of those, 4 of those 5 rating actions have positive connotations.
Now, for headwinds for the banks, I mean, I've heard analysts continue to tell us that going forward, these banks, Nigeria, outside of in Africa as a whole, will continue to face headwinds, including rising global interest rates, increasing government debt, and domestic currency pressures. For Nigerian banks, how would you rate their ability to weather these storms?
Well, I suppose maybe those wouldn't be our most pressing challenges for the banking sector. But if we look at foreign currency liquidity, which was a major concern a couple of years ago, and in fact one of the rationale for any negative action taken on the banks, I think that has eased tremendously. Some of the banks have issued foreign currency medium-term bonds, as you know, so that has given them some respite in terms of pressing foreign currency liquidity pressures. The authorities in Nigeria have taken steps to ease access to foreign currency, and that seems to be going quite well. So on the liquidity type foreign currency repayment problems, we see the situation far better. Rising interest rates, well, that really depends. You know, these medium-term bonds are fixed rate, so that shouldn't affect the banks. And in terms of we're more concerned, or we follow more closely the interest rate environment within Nigeria, and look at recent stability on those rates. So our headwind really would probably be very much linked to oil production and oil prices. We note that the Nigerian banks are still heavily exposed to the oil sector, and to the extent that prices improve or continue to improve, then so does debt servicing on their oil-related portfolios. So that is looking more stable or mildly positive. In terms of mounting asset quality problems, there's a number of things there. The banks have also gone through a major revision in accounting treatment at the beginning of this year, and they're still finding their feet really in terms of how they report according to these new IFRS 9 standards. So we'll be looking for continued quarters, continued months to go by before we can really comment on the trends in asset quality.
Okay, last question. I'd like you to quickly comment on what Axis Bank has just done. It's just announced that it would redeem its $400 million 2021 Euro bond in 2019. It says that is doing this to reduce financing costs, and says it will explore other sources of capital, of course, wanting to keep its capital adequacies well above the 20% threshold, and may retain more of its profits rather than giving them out as dividend. What are your thoughts on that?
The thoughts on capitalization are that these major Nigerian banks, which are the largest ones in the system, are on the whole adequately capitalized, and indeed their capital adequacy ratios are well above the minimum required by the regulators. Maintaining a capital adequacy ratio in excess of 20% is not unusual for the large banks in Nigeria. So by explicitly coming out with a target, Axis is not doing anything which is revolutionary anyway. I mean, it's sort of stating that it wants to be among the levels that the other big banks achieve. In terms of redeeming bonds, I mean, Axis would not be the first Nigerian bank to take this kind of action. Other banks have done that in the past, and to the extent that there is less demand for foreign currency borrowing, so lower demand to make new loans in dollars, then it does seem to make sense to manage the balance sheet on the liability side as well and reduce that.
Janine, thank you so much for talking to us today.